Well, hello and welcome. You're watching Halftime Report on CNBC-TV18. I'm Ekta Batra. With me is Mangalam Malu, and we will have Sonia joining in with some important details on the EV space. But as of now, it's a good session for us. We have the Bank Nifty, which is outperforming with gains of around 0.8%. We have the mid-cap index, which is up around 0.4%. No complaints really coming in. And we have a strong macro cue in terms of a tailwind for us, which is basically Brent crude prices, sub $90 for Brent crude at this point in time. Multi-month lows which have come in for that particular commodity. So thumbs up for us at this point. Hi, Mangalam.
Thumbs up indeed, but we're facing some sort of resistance upwards of that 17,900 to around that 18,000 mark. So let's see where we go from here. In the meanwhile, we have the August mutual fund data coming in. The net equity inflows have come in at around that 6,120 odd crore mark. This is a decline month on month. The same time last month we did close to around 8,800 odd crores in terms of net inflows, though we are still waiting for some more details with regards to the kind of SIPs that we've seen, etc. Hybrid schemes, whether there has been an outflow of there as there had been in both June as well as July, and what's taking place in all the other parts of the mutual fund universe right now. But what we can't deny is the sort of equity cult that is growing, and the demat accounts having crossed the 10 crore mark in the very recent past. And that's something that we will monitor. The net equity inflow has come in at around just shy of that 6,000 crore mark, 5,942 crores. This compares with 8,882 odd crores month on month. We'll await some more details on that.
Yes, absolutely. That we will also have a guest joining in to decode all of these numbers. Like you can see, the hybrid fund outflow has been larger on a month-on-month basis, over 6,600 odd crores. But let's move on then. The Mahindra Group has launched its first fully electric SUV, the XUV 400. While the company says it will announce the car's price only in the month of Jan, the car will be Mahindra's mainstay till about 2024. The auto major hopes to target an Indian SUV market of about 90,000 customers across two segments. Jude Sanith caught up with the M&M Executive Director for Automobiles. Let's listen in to some of their plans.
We are very, very excited to launch our first electric vehicle on this milestone day. We think it's a very good offer. It's a C-segment electric SUV because when you compare it with any other C-segment vehicle by way of either size or capability, including acceleration, it's right out there.
Absolutely.
There's a 30,000 plus market right now of ICE SUVs in the C segment. Another 60 odd thousand of the B segment. The Ford OO, as we are now calling it, allows us to straddle both.
Okay.
And hence we really think there's a big opportunity because the current penetration of electric in both the B SUV and the C SUV segments is very small. Less than 1% in C and about 3 to 4% in the B.
Absolutely.
So big opportunity ahead, and of course customers will take time to move, and hence we think this is a launch where we need to give time.
Okay.
Right? It's a category evolution and a category creation. We want people to experience the product and not get into here's a product, let's start booking tomorrow. So, it's being planned in a way that we reveal today, and we take the next 3-4 months to get customers through events, experiential drives, to experience us, and then we open bookings in January.
What's the investment that's gone into making this vehicle, Rajesh?
This has been in the region of about 500-600 crores, which includes creating the 4.2 meter version. So it's not just the electric, but in that range.
The first of the Born SUVs is slated for launch in late 2024. What's the pipeline like up until then? Are you looking at further launches? And is there an affordable offering in the electric space also sometime in this period?
Our brand is about creating authentic SUVs which customers feel passionate about, with adventure, capability, so on and so forth. So value proposition is important, but we are not necessarily into the A to B fleet operator segment. We will bring out products which excite customers, which customers feel passionate about, and the 400 is the first in that journey. Between now and 2024, we have no other launch in the electric space. So this is going to be our mainstay for the next couple of years.
What entails really the strategic partnership with Volkswagen? Can we expect both brands to retail each other's cars, for instance? What else does it entail?
So the first part of this partnership with Volkswagen is about buying the MEB platform components, which will go into our own InGlow platform. InGlow is our own Born Electric platform, for which we will leverage components that we'll get from MEB platform of Volkswagen. So that's the first part of it. Right? Now that involves some amount of localization and so on, which is all going to be under discussion.
Okay, all right. Before I let you go, I have to ask you, we're in an extremely challenging time right now when it comes to supply chain and procurement concerning the EV space. One, there's talk about Chinese control over lithium, the fact that it's tight-fisted with regard to supplies. Then you also have several issues surrounding semiconductors. While I understand the latter may be sorted more or less in the near to medium term, does the lithium supply crunch worry you from a sourcing standpoint?
One of the advantages of tying up with Volkswagen for the InGlow platform, which is where we'll use the LFP, which is lithium-based, is that Volkswagen has a vertical integration back all the way into the supply chain. And we believe that's going to bring great value to us. In the next 2-3 years, availability of minerals which go into electric is going to be one of the big global challenges. And tying up with somebody like Volkswagen enables us to get the leverage of their strength and their vertical integration.
So sourcing shouldn't be much of a trouble in that case?
Will be better than what we would have been in a situation otherwise.
All right, so that's about the Mahindra electric vehicle. In fact, incidentally, it's also the World EV Day today. But as we speak, we have some more details pouring in from the mutual fund data coming in for August. And as we speak, we do have, Sumaira with us joining on the phone line. Sumaira, the overall flows have reduced, but that's largely on account of the outflows that we've seen from the hybrid funds.
Yeah, so, you have to look at it in different segments, right? Now, equity inflows have been coming down. This is the third month that inflows have fallen. But within that also, it's interesting, right? So, as of now, the overall number is just under 6,000 crores. But this includes 3,000 crores of NFO money. Now, NFOs generally tend to get a lot more attention, right? So, if you strip this of NFOs, it's only 2,000 crores of inflows which have come into the existing funds. And even over here, there is a marked preference for the mid cap and the small cap funds. The large cap funds actually haven't seen the kind of inflows that the other segments are seeing. Besides this, debt seems to have had a decent month, so 49,000 crores in terms of inflows. Now you mentioned hybrid, so let's talk about that. Within hybrid, it's now the fourth month where we are seeing net outflows on a category level. But if you split hybrid, you will see that most categories are doing well, right? So balance, advantage, etc. are continuing to get in money. It's arbitrage funds where the problem is. Now, last month as well, arbitrage saw an outflow of about, I think, 5,000-6,000 crores. This month, again, arbitrage has seen an outflow of 8,500 crores. The reason for that is that, at one point, spreads were shrinking, right? So people were, because of the negative returns, they were moving to arbitrage. Now that returns have turned positive, people are taking money out of arbitrage once again. So therefore, nothing really alarming over here. Passive funds, very, very heartening. They have seen another very, very good month. So on the whole, they have done about 15,000 crores in terms of inflows, with only 200 crores of NFO money coming in, right? So this is all money that is coming in, sticky money that's coming in to existing funds. The AUM has also, for the industry, has grown now to over 39 lakh crore rupees. The SIP number we will get shortly. We don't have that number yet, but all indications are that this number too should be pretty heartening. Back to you guys.
Okay, Sumaira, thanks a lot for that. So the equity cult perhaps continues. Let's do one thing. Let's take a quick break on that note. On the other side, more on stock-specific action coming up. Stay tuned.
Welcome back. Well, holding up steady for the markets. A couple of stocks such as Rain Industries is having a very bad session. So down around 7% for that particular counter, impacted by the gas issues which Europe is facing in terms of their operations there. But nonetheless, let's talk about a couple of other companies which are in focus. Sources, in fact, tell CNBC-TV18 that Ujjivan Small Finance Bank is likely to launch a QIP early next week. Abhishek Kothari is getting us all of these exclusive details. Abhishek, over to you.
Well, as you mentioned, Ujjivan Small Finance Bank is going to launch a QIP next week. That is what sources is telling CNBC-TV18. So they may look to raise around 400 to 500 crore via this QIP. The QIP is likely to have a minimum base offer of 20 crore equity shares. So capital raise would strengthen the balance sheet of the bank, and there have been two domestic bankers which have been appointed for this issue. So demand is pretty healthy for the issue. Book has already now seen 125% of the demand that they were ready to offer. A calculation shows that if you take into account a 500 crore capital raise, the net worth will strengthen by 16.6%. Book value will increase by more than 3% to close to about 18 per share. Equity dilution will be around more than 13%, that is about 13.2%, and tier 1 ratio, now that will strengthen by almost 386 basis point of what they reported in Q1 FY23 to now about 22.6% post the equity raise. We have written to the bank and we are still awaiting their response. Back to you.
All right, Abhishek, thanks a lot for that. So that's about Ujjivan Small Finance Bank. We will monitor the QIP developments early next week, as Abhishek pointed out. But just keep an eye out on Container Corp. That stock has done well all through the last couple of trading sessions. And now as well, it opened flat and now we've seen a big surge on Container Corp. That stock's up with a gain of almost 4% as we speak, taking the weekly gains of the stock to around 13%. And, this year, because of the gains that we've seen in this week itself, the stock is up 24%. But we were talking about the EV space, and today being the World EV Day, let's discuss the growth globally. Sonia has now moved to the big wall and she'll give us a lot more data.
Thanks a lot for that. So on the occasion of World Electric Vehicle Day, we decided to stack up the numbers to tell you about the global adoption of electric vehicles and how it has progressed overall. The electric vehicle market across the world has grown at a compounded rate of 50% between 2019 and 2021. Within that, China is taking the lead, US is catching up, and Europe is falling behind. Now, China has the largest and fastest growing EV market in the world, and the number of units sold in China has risen from just 10.6 lakhs in 2018 all the way to 31.6 lakhs in 2021. Even if you compare 6 months of the calendar year 2022, China sales have risen from 11 lakhs all the way to 23.7 lakh units year on year. Let's now move to the US markets. The US electric vehicle market size was just $24 billion in 2020. The market is projected to grow from $28 billion in 2021 all the way to $137 billion in 2028. That's a compounded growth of 25% between 2021 and 2028 period. Now, India, which falls under the rest of the world region, has seen outsized growth of 90% in electric vehicles in the last 3 years alone. Over the last 3 years, if you look at it, sales of EVs in India have risen from just 4,800 units in 2020 all the way to 19,750 units in 2022 so far. That's a growth of 300%. Company-wise, of course, we know that Tata Motors is the largest selling EV company with sales of 17,855 units in 2022 so far. However, there are still many challenges in the mass global adoption of EVs. The biggest issue, as we know currently, is the energy crisis across major developed cities in the world. California, for example, has asked electric car owners not to charge their electric cars during peak hours because of the load on the power grid due to the heat wave. Even in India, issues like range anxiety, lack of charging stations, inadequate battery swapping technologies are some impediments to the fast adoption of EVs. Nevertheless, the future is looking bright and India's electric mobility journey is gaining momentum. KPMG, for example, estimates 50 million electric vehicles on Indian roads by 2030, compared to, guess what, just 1.4 million currently. Back to you.
Okay, all right, Sonia, thanks very much for that. What stood out to me was the term range anxiety, which comes with electric vehicles. But nonetheless, growth is expected to be quite strong for the Indian markets, as you can see, and as Sonia said. But let's talk about the AMFI data, which just came out a couple of minutes ago for the month of August. Sunil Subramaniam, MD and CEO of Sundaram Mutual Fund, joins in to discuss the mutual fund data with us. Sunil, hi, welcome to the show. I just wanted to start by asking you about the equity scheme inflow, because we just heard Sumera talk about it. For the month of August, it's at 5,942 odd crores, compares to over 8,800 crores in the previous month. And a large part of this is also expected to be because of the NFO funds. So net, existing funds probably got much lesser than this 5,900 odd figure. Can you just break up the details for us and your perspective on it?
No. Actually, there's a slight misunderstanding there. NFOs started only, subsequent months. So April to June, there were no NFOs. Okay. And the NFO, SEBI had an embargo on NFOs, and that got lifted only from July 1st. So the speed and momentum of NFO is gradually picking up. So I don't think that will be a big number for the last month. This month, the situation will be different, and there'll be a lot of NFOs, including Sundaram Mutual's NFO, which collected around 1,680 crores, has come in this month. So it will get allotted in the coming month. So I think that NFOs actually, because of the embargo, that's one of the reasons the flows have been less. So it's a lower NFO percentage than in the previous quarters.
Take that point. So lower NFO percentage in the previous months implies the lower inflows that we're seeing in equity schemes itself. What's standing out is the kind of flows that we've seen in ETFs, passive funds, and that's been above that 13,000 crore mark for the last 3 months. In fact, over the last 5 months, it's garnered almost 75,000 crores in terms of flows. What are your thoughts on active versus passive investing, and whether this is a trend that is going to continue?
See, to the extent that the provident funds and the NPS money is coming in, right? A lot of the provident fund money is mandated to go into passive funds. So as government keeps increasing the amounts that PFs can invest in equity in order to make sure that some reasonable returns can be given to their investors, I think the support for the passives will come from the institutional space in a pretty significant way and in a good way. That's one thing. The second thing is what is happening in the passives is that a lot of passives are now coming into the sectoral space, into the overseas space. So what happens is that earlier it was just a large cap ETF, right? But now you're having you have an EV ETF, for example. You have the slicing and dicing the whole sectoral pie, because if you're going to go into active fund management in these kind of niche plays, right, it's very hard to find a total pool of stocks to manage them actively. Whereas if it's an ETF and there's an index with about 30 stocks and buy only those 30 stocks, I think so increasingly those who want to play the high risk, high reward, very focused niche plays, you'll find that even HNI's money, in addition to institutional money, will flow into passives. The third thing is that in the large cap space, there are two things which happen. One is when FIIs come in, right? Large caps, as a rule, go up. Now, a fund manager trying to pick a stock within a large cap to say this will outperform in a time when liquidity is dominating the flows is very, very hard. So you'll find that large cap funds, when there is a good flow coming in from FIIs, are the most challenged to beat them, because stock selection doesn't play that important a role when the liquidity is raising up the entire index, right? So then what happens is the large cap funds find struggle to hard to beat. So in the large cap space, the HNI investors are saying that why do I pay that 1.5–2% for active management? In any case, the whole index is driven by liquidity. Let me allocate. So that's a movement which you will see gradually, that HNIs who understand the market, understand this, will put money into niche ETFs, will put money into larger cap ETFs. But at the same time, the other thing which is happening is that, without taking names, is that not every stock that comes to an index passes certain filters. It may pass the filter for index inclusion, but it won't pass the filter for a fund manager to buy, because there are different things. There are corporate governance, there are allocation issues, there are how much of promoter holding is pledged. There are a whole bunch. I can't take stock specific names, but when these things happen, right, so fund managers choose not to buy them for not just price versus value reasons, but for a whole larger thing. So in that sense, when those kind of stocks outperformed, and they will then tend to make the index beat the active managers. Similarly, when one particular stock, which you saw a few months ago, right, when one particular stock takes a huge weight in the index and fund managers are restricted to 10% for a single stock allocation, and if that stock goes to 15 or 20% of the index, then you can't match the index even if you want to, right? You can't outperform with betting on that stock or picking that. So these are various reasons where in the larger cap space and the niche space, you will see the growth of passive funds will be fairly decent and grow, and especially in HNIs and institutions which are very cost sensitive to this issue. But in the broader flexi cap, multi cap, mid cap, small cap over the medium term. I still believe active fund management has a role that over and above the expense ratios, they can deliver alpha, and I expect that they will continue to support the active fund management industry in a significant way.
Okay, I just had one question on what's happening with the debt flows. The total debt scheme inflows, they've come in at 49,000 crores and it was just 4,900 crores last month. Am I missing something here?
No, you're not missing. What you're seeing is that the US interest rate hike, right, means that interest rates which are going to rise there, RBI will have to follow with gentler rate hikes because Indian inflation is not in that bad a situation. So whatever rate hike can happen in India is kind of at a peak. So those debt investors who were avoiding it because a rising interest rate scenario means the mark-to-market loss, today are feeling that this is kind of peaking and Indian interest rates would tend to flatten and stabilize at these lower levels. So locking on to the currently prevalent higher rates through a rolled on maturity fund or a target maturity fund or an FMP makes good sense today. That's number one. Second is the news about India's inclusion in the bond index. Now, if that happens, FII flows will come in and you will see at the longer end, interest rates will come down because of the demand supply, because the demand will rise from foreign investors and will supply. So longer term, if you take a longer term paper, you can look at mark-to-market gains, in fact. So this two things significant shifting, that US strong interest rate, and then the third thing, sorry, I forgot to mention that, the larger the interest rate hike in the near term by the Fed, the more the chances of a recession being advanced and coming forward, and the more the chances of a rate cut scenario, let's say 6 to 9 months from now. So the debt market's trying to look at it a 3-year perspective, says today they are peaking, but by the end of 3 years they'll be down, then it's a good time to invest because I'll get mark-to-market gains. So there are 3 movements here, which are 3 separately I've delineated, which are indicating that it's not a bad time to lock into good yields in the debt side.
Okay. All right, Sunil, we're going to leave it on that note. Thanks very much for joining in and speaking with us and giving us your perspective on the data for the month of August when it comes to inflows into the equity as well as the debt markets. Well, we need to take a short break, but just watch out for the multiplex stocks because I think they're reacting Friday to Friday in terms of what could be happening in the theatres, the inflows, and, you know, there's that Ranbir Kapoor movie, right?
Brahmastra.
That's what everyone is, that's the only thing people are talking about right now, and the fact that perhaps collections will really be low because the first review is not so good. But you know what, I mean, give and take everything, I would still go out there and watch the movie purely because of the kind of production value that has gone into it, right? And after such a long time, you're seeing such a big...
Each to their own, and wait for it to just come on, you know, on one of the Netflixes.
People have become extremely tough on all these movies. If it's not entertaining... Earlier, you would watch a movie which had about 2.5, 3 stars as well, but now no one expects any less than 5 stars.
Because your competition from OTT is so much.
And the investment is so much, right? You're investing your time, and per ticket prices are expensive. Popcorn's expensive. A family goes there, it's an outing for 3,500 rupees.
Absolutely.
And, well, you expect nothing less than the best.
I think the structure of the market has changed. The structure of content has changed, and I think people need to sort of...
But, you know, just for the industry, I mean, I just hope it doesn't bomb that badly because... There are several people who are involved, right? I mean, this movie has been in the making for what, 4 or 5 years?
6, 7 years. You know, the only thing that I'll be watching out for is what happens now. And the reason why both PVR as well as Inox are falling is because September 9th is where this movie releases, which is today. And if this tanks, then we have absolutely no visibility of good content till September 30th, where you have Vikram Vedha as well as Ponniyin Selvan, 1PS1 as the Tamil, you know, name is. So up until then September becomes a washout. August anyway was a washout, and as was July. 270 crores in July, 140 crores in August. September may be lower than that.
But it has a fantastic star cast, and I would watch the movie simply because Shah Rukh Khan, I think, is also in it, in a cameo. But nonetheless,
thank you for spoiler, Ekta. On that note, what we'll do is take a short break.
Ekta's going to be spending 3 hours just to see Shah Rukh Khan for that 1 minute.
5 minutes, all right.
Anyway, we need to take a short break now, but up next, we'll tilt on the markets. Prakash Kaba will be with us.
Welcome back to Halftime Report. All right, for the market, it's given up a lot of its gains. Actually, it's completely flattened out now for the Sensex and the Nifty. The market is well off its high, so 17,829 is where we are at. Remember, the high of the day that we had today was 17,926. So as you can see, losing all of its sheen, early morning sheen, that is. Prakash Gaba is joining in now on the show. Prakash, hi, good afternoon. Your thoughts on what's happening with the market? Overall, it's been trending higher. We're at a 1-month high, but a little bit of cool off right now. Thoughts?
Well, good afternoon to you. What I would say is that the market opened with a bang and is somehow couldn't sustain there, and then finally started giving up its game. Looks like we might see some more downside. Yes, trading at 17,800 in our market. Very good chance we can see to 17,700 is a good possibility. So far I see some weakness, I don't see strength. The strength has not been able to hold on. As far as Bank Nifty is concerned, I think it's still weak. The first technical target is 40,200 and possibly 40,000. That's a strong support zone to work with. It looks like it should come there. It should not today, then maybe on Monday. But it looks like it's weak to me, the Nifty and Bank Nifty. We need to be stock specific and then trade long. Otherwise, stay out of the market completely.
Take that point. 17,926 is today's high, Prakash. And, I was looking at the period between August 17th and August 19th. We had the Nifty retrace from levels upwards of 17,900 thrice in a row, and that is when we went lower all the way down to 17,166. Of course, that is not to suggest that that may happen now as well, but the point is that there is resistance above levels of 17,900. You said one has to be stock specific. What are the stocks that one is looking at right now?
I would look at two stocks. One is the Apollo Hospital, looks okay to me. Very good chance we can see an up move here to maybe around 4,500 zones. Trading at 4,460 now, Apollo Hospital. Where do you have a stop? I think would have stopped below 4,435 and trade long Apollo Hospital. Second stock that I like is perhaps Dixon Technologies. Seen a good up move. Should climb up even higher. Trading at 4,528 now. Possibly we'll see 4,600 in the days to come. Stop below 4,500 should be fine.
Okay, since it's the hot topic of the moment, Prakash, your thoughts on PVR and Inox? Stocks are down 5%. Reviews are not looking good for Brahmastra, but are you going to watch the movie and how are you trading the stock?
I think people have changed the habits, Sonia, that people have stopped going to the theaters because they see, if not this month, maybe next month we'll see it online. So the habit has gone because COVID has made us sit at home. So I'm not watching the movie there certainly, and looks like the bookings are also not much. I don't think the review matters, maybe because the COVID fear is still there and the habit changes happen. So that's the issue out here with Brahmastra. And PVR is looking weak to me. It's trading at 1832 zones. Very good chance we could see it slide to 1750. Stop about 1900 should be fine on PVR.
Prakash, you're an old-time movie lover, right? What, according to you, will get people back to the theaters? I mean, the charm of a big screen is still not out. I mean, is there something you think can bring people back to the theaters?
It's difficult. Let me explain one more thing. We stopped getting the newspapers when COVID happened. We still have not started. The habit has changed. Could you ever imagine Times of India will advertise for Times newspaper? Which is a morning habit. The habits have changed. We've stopped going out to the clubs. Call from outside, cloud kitchen. So the habits have changed. My club, Otters Club, is normally empty these days. People are not coming in. The footfalls have reduced. So that still matters. Until the habits come back to normal, it may take its own sweet time. So PVR looks like it should hold.
Okay, that point is taken. Habits have changed because of COVID. Completely understand that, Prakash. From a healthcare perspective, more awareness for people to get themselves tested for various conditions as well. We need to take a short break. A quick reminder for our viewers as we do that, it's that time of the year again. Money Control Pro's Financial Freedom offers back with added benefits. Get a Money Control Pro subscription at net zero cost by claiming exciting offers worth 1,500 rupees from our partner brands. Grab the benefits now only on the Money Control app or the website.
Well, here's a big CNBC TV18 exclusive. Shireen Bhan caught up with Noel Quinn, the group chief executive at HSBC. He says that no global economy will be immune to the economic slowdown. But he also states that India is extremely well positioned to ride out the slowdown.
I think the important thing is to look at the economic impact on a regional basis because it's different for different regions. I think continental Europe does have a challenge in that there's significant price inflation, but there's also an energy supply concern. The UK and the US have less of a concern on energy supply, more of a concern on energy inflation. And then if I look at the Middle East, very different economic circumstances, a very strong economy in the Middle East. And Southeast Asia, very strong at the moment as well. Nobody's going to be immune from an economic slowdown, but I think the impact of it will be different in different regions. And I think you see in Hong Kong, there's gradually a rebooting of the economy there as COVID lockdowns have released. So I think you've got to look at it regionally, not globally. And here in India, I think India is extremely well positioned to ride out an economic slowdown. It has strong domestic demand. It has good FDI, $83 billion worth of FDI last year, strongest ever. It's starting to build up good trade flows. So I think India is well positioned to ride out an economic slowdown.
And, you know, the question then is what happens to fund flows, and will fund flows continue into markets like India? And, you know, we're often sort of equated with other emerging markets as well. Do you believe that with interest rates tightening the way that they are at this point in time, that could potentially impact fund flows into markets like ours?
I think India is in a good position relatively for positive fund flows, and I think that's all credit to the way the economy has been managed. During COVID and post-COVID, rapid response in the build-up to COVID in India, rapid response post-COVID to adjust back to more normalized economics. On interest rates, by the way, it's good to see that normal monetary economics are starting to re-emerge. 0% interest rates is not a normal monetary policy. Now, we're all concerned about them having to rise too fast, too high in response to inflation. I'm hoping that, and have a belief that, some modification will take place in the demand curve because of inflation, and that maybe rates won't have to go quite as high as we currently think, because demand will adjust, not because of rates, but because of inflation. And I think there is some evidence of that starting to emerge. In terms of India, I think it's really well positioned as an investment market and future FDI coming into India.
You know, you said that we might see demand taper on account of inflation, and hence the expectation that we are going to see significantly higher interest rates may not pan out. What would be the rate that you are at this point in time looking at? What do you believe we are going to see the Fed move to?
Well, listen, it's very hard for me to predict what the Fed will do, but I think everyone's baked in a pretty certain future of at least 4%. It could go higher, and many people believe it will. I think we're going to have to see how the demand curve changes over the next few months. But certainly we can be looking at 4% interest rates from the Fed, and potentially higher than that.
All right, with that, we take a short break. On the other side, we get you all the things on commodities with Manisha Gupta.
Welcome back, and joining us is a very special guest now. Vandita Pant is Chief Commercial Officer at BHP Group, and she joins us exclusive on CNBC-TV18. Vandita, hi. I want to start with the commodity markets and the way they have been reacting for last some few months now. Would you say it is all about macro? Is it about the way the US dollar is behaving? Is it about the individual fundamentals that you see impacting the prices?
Yeah, very glad to be here with you, Manisha. The macro has a lot going on, as you said. There is, of course, the interest rate in the US, and whether the balancing of inflation pulls and pushes land softly is one issue, but equally the issues around volatility, geopolitics, etc., all coming into making it quite a volatile macroeconomic background. And I think of it in a particular way, which is, are we getting into slower growth for rest of world? And I'll explain rest of world going forward a little bit than what we thought was the case earlier in the year. Absolutely. However, I do think that over a period of time, over 12 to 18 months, China, interestingly, can be a source of stability from the world growth perspective, because that's one country where the inflationary pressures are not there, is a very important one for commodities, of course, and has all the levers, fiscal and monetary, to start to stimulate the economy, which, of course, is a very big end use. So I would say volatile background, macro, globally, absolutely. We don't think it is at a cliff though, and US can really escape the fate from a recession perspective, but in China, in 2 quarters or so, can start to become a source of stability for the world.
Fair point. I also want your view on the energy space, Vandita, because that is really buzzing, and this is going to be a second straight week of decline here. But whether it's about crude oil prices, which is volatile, natural gas, which is very, very volatile, would you look at the Russia-Ukraine conflict or the Europe energy crisis and the way we are looking at various statements now coming in from Europe leaders?
Yeah, indeed. I think energy cost and the mix of energy under use is really a concern, absolutely. If you see the inflation part, energy and food inflation are 2 of the biggest drivers, and they will linger for a bit. I think it's also fair to say that some part of the inflation in the world, which was coming because of port congestion, manufacturing base, supply chain issues and constraints, we see that already coming down. So one part of inflation driver, which related to really supply chain congestions, coming down. However, structural bits and in energy inflation will tend to be here for a while. And what that means is even in our own operations, we have seen that come through, be it diesel pricing or electricity pricing as input cost to us has seen a real increase. Having said that, as you know, we have done very well on cost discipline compared to everyone else in the industry, and hence we are the lowest cost producer of iron ore in the world for 3rd year in the running, and similarly our cost control on unit cost.
Fair point. Since you talked about the caustic part of it, what's your sense on the prices then? Because we've seen commodity prices come sharply off from the kind of highs that we've done in this year, off from the lows as well. We're somewhere trading on the lower side of the band though.
Yeah, I would refrain from directly making a reference to prices, Manisha, if I may. But what I can say is from a demand perspective, India, for taking steel into account, for example, as I said, we are forecasting around 8.5% growth in steel production this year for India versus last year. We do think that 300 million tons of India's ambition for the end of the decade sounds very ambitious, but even if you were to haircut it by 10% or 20%, we are still into 250 million tons, which is a massive increase of growth. And by 2050, India could very easily be at a stage of 400 to 450 million tons of production of steel. That in a market which currently is 1.8 billion tons in the world, makes India one of the absolute leaders in steel production.
That's about steel, and you've spoken about various commodities here, Vandita. But going forward, what are the things that you would want to watch out for? Because we still are in a very uncertain scenario in the global markets. So what are the concerns? What are the fundamentals that you're keeping an eye on?
So I would say Europe continues to be a concerning region. Of course, given the Northern Hemisphere winter coming in, energy challenge will be more acute. And that does mean that it already flows into the industrial activity in that region. So that region is one of the weak spots, if I can put it that way, overall. Overall, we would think world growth at 3.25 next year is very much doable. US slower growth, absolutely, but we can also see that a peaking of inflation happening in 2 quarters' time in the US. What that does mean is there will be structural inflation which continues for this decade, because it's obviously a fact that this decade is going to be higher inflation than the previous decade view. Of course, at a one level, I would say recession talk, especially in the US, is a bit of a moot point, where economy is almost at full employment. And as you know, growth for growth's sake is not really the point. The issue being if there is full employment and the demand dynamics continue okay, we wouldn't call it a recession economy at all.
Okay, Vandana as well as Manisha, thanks very much for taking us through that conversation. We need to take a short break on that note with the news that we have the Bank Nifty, which is off the day's high but still holding up with a gain of around 0.6%, and the Nifty too, currently at around 17,848. We'll take a short break, get you more on the other side. Stay tuned. Welcome back. Well, one of the stocks that I'm watching today is Lupin. That stock should come up for you. It is an important launch of a drug in the US is the reason why the stock is in focus. They have launched Suprep generic, which is basically a drug which is used to clear out your colon before a colonoscopy. It is expected to be a strong, revenue generator for Lupin because they have 6 months exclusivity on this particular drug. It's generated sales of around $200 million. So that's the market size of the product. The street is estimating that Lupin could probably make $30 million in FY23 from this drug, and then an additional $30 million in FY24 as well, because in FY24 the exclusivity is going to taper off. That means an EPS addition of anywhere between 3.5 to 4 rupees for Lupin. Remember that the US business has been struggling. They have guided that they'll reach $200 million. So these kind of approvals and launches will help. With that, it's a wrap on Halftime Report. Business Lunch up next.